we're back for episode 6 of the Cash Flow Corner, along with myself, Aaron Thomas, and my brother, Jacob Thomas.
Yeah, welcome back. Welcome back in here for episode number 6. We're happy that you guys, the listeners here, are continuing on with this journey on this podcast with us. We're hoping you guys are finding a lot of valuable information from the past episodes, and we hope that we can continue to deliver and give you guys some more information. Not only on this podcast but moving forward as well. I know, coming off this past episode 5, we had the chance to actually have our first guest on, Amanda Larson. So shout out to Amanda Larson if you're listening to this episode. We appreciate you for coming on to the podcast and giving our listeners, just a different voice to kind of, absorb some information, listen to her stories. And, I thought she had a really, insightful information and stories. So if that's something where you guys haven't had a chance to listen to episode 5 yet, definitely go back to that and give it a listen. But outside that, Aaron, how are you feeling?
Yeah, I'm doing great. And like you mentioned, a big thank you to Amanda Larson for coming on our podcast for episode 5. We've got a lot of great feedback from that, so I think our listeners enjoyed. And like you mentioned, if you haven't given that a listen, I highly recommend going back and listening to that. A lot of good information, a lot of good knowledge. It was just great hearing her story and really how she progressed in her investment career of really going from a limited partner and investing passively to then moving to a general partner, which is exactly what we're aspiring to do. So that was just great for us as well, just to hear her story. And everything else is going well. It's hot out here in Arizona right now, but luckily we're going to be able to sneak back to Michigan here pretty soon to escape the heat. So pretty excited for that. But yeah, everything else it's going great. How are you doing?
Yeah, thanks for asking. I'm feeling pretty well. Like you said, we're out here in Arizona in the middle of July, and let me tell you, it's not for the faint of heart or for the weak out here. It's definitely hot, but yeah, like you said, we have a couple trips planned back to Michigan over the next month or two, so it'll be really nice to catch up with some family and some friends that we haven't seen in a while. Definitely cool off, so it'll be nice to get back to Michigan for a little bit. But outside that, in terms of the podcast, we're looking forward to having some more guests in the pipeline down the road here. So looking forward to that as well. But on top of that, we've been getting a few questions from some of our listeners, things such as, kind of what's going on in the current state of the economy. What does the market look like? Interest rates. We've had a lot of different questions, and you know, I feel like a lot of people want to pick our brains, Aaron, of where do we view the market right now? How are we kind of forecasting or projecting um, things to look like in the future of 6, 12 months down the road and what that looks like? And actually, the first topic I want to touch on is, as some of you may know, the Fed meeting this past month or at the start of this month. They came out, and it sounds pretty optimistic in terms of some interest rate cuts. I actually read a stat that they're saying anywhere from 80 to 85% chance of a rate cut upcoming this September. So, as I'm sure you guys know, with the Fed, you kind of have to take that information with a grain of salt because we'll believe it when we see it, kind of thing. But I feel like that's going to have a direct impact not only on the economy but certainly commercial real estate investing. So, Aaron, if you kind of had to break down the landscape or what you're kind of forecasting or viewing in this current economy with interest rates, how is that going to affect different investment opportunities here in the near future? Where is your mind at?
Yeah, so like you said, the Fed has come out and said that they are planning on cutting interest rates in possibly September, either that be 25, 50 basis points, whatever it may be. But really, this is what commercial real estate investors and commercial real estate professionals have been waiting on for the past 12, 18 months, because with interest rates skyrocketing over that time, there hasn't been as many transactions. Transaction volume has been down immensely. So with rates coming down, it is going to provide more opportunities here in the near future. Just because with interest rates so high, it's been tough to make deals pencil and ultimately make sense financially. So with rates coming down here in the next few months, it's ultimately going to provide a lot of opportunities because, like we've been talking with a couple of other investors previously, when interest rates have spiked and then proceed to come down, the stock market and other investments tend to decrease as well. So, just talking to other investors and getting that information out, as it could be a good time to possibly diverse your portfolios, is what we're telling our investors to really look at commercial real estate as a possible investment here in the near future, because whenever rates do start to come down, there's going to be just so many opportunities here, because if you can find a deal that makes sense here in the next 3 to 6 months with some possible still high interest rates, but they make sense financially and in terms of underwriting, then whenever the interest rates do come down, that will ultimately increase the property value and increase the investors' returns. So really excited for that. I know we have maybe some possible future deals lined up here in the pipeline. So we're excited about that. And other than that, I feel like the economic forecast is looking on an upside from a commercial real estate perspective.
Yeah, those are really good points, and thanks for sharing that information. And the one point I want to go back to is what you mentioned about the transaction volume within the commercial real estate space is down tremendously. Like you mentioned, it's actually down to the point of 2021 lows, so the COVID lows. So we're looking at unprecedented times in terms of, there's just not a lot of deal flow out there right now, but there's a lot of optimism as we go forward throughout the calendar year of possible interest rates cuts. And the one caveat, or the one point I want to make about, interest rates being involved in increasing the return on an investment property is it's an external factor, obviously, that's out of your control, but it's very beneficial in terms of when you, let's say, for example, if you buy something at a high interest rate right now, over the course of the hold period, as those interest rates start to decrease, you're going to have a few options of whether you want to refinance and restructure your debt that way, or obviously you can go throughout the hold period and eventually sell the property as well. But you have to be careful to note that when we're looking at deals right now, obviously that's something that could happen, but you have to plan for your business plan no matter what interest rates are. So being able to develop a really good business plan is only going to set you up going forward. So that's a crucial aspect to mention there regarding interest rates and how that would affect a potential deal.
Yeah, and I think that's a great segue from the economic forecast of interest rates to what you mentioned previously of breaking down the life cycle of an investment syndication deal in terms of a limited partner or passive investor's perspective, and really breaking the life cycle down. The first big main step is, I know we mentioned this in a previous episode, but it is deal sourcing and evaluation of certain properties. And this is done completely by the general partner and their team of really just trying to find a deal and a property that they believe they can implement a solid strategy in to ultimately increase the NOI, increase the value of the property to have greater returns for their investors. So that step just involves looking at deals, underwriting, and finding deals that they believe are financial opportunities to really capitalize on. And once they find a property that meets their determined criteria and it's aligned with the investor's criteria, the next step is then to send that out to a list of limited partners or limited passive investors who may be interested in committing capital and investing in that certain deal.
Yeah, that's a really good spot to start. And I think it's an important note here, Aaron, that what we're trying to do when we're talking about the life cycle of a syndication deal is we're going to try to put ourselves in your shoes as the limited passive investors. So, like you said, from ground one or from level one, you're going to have the GP who will be doing deal sourcing, analyzing hundreds of different properties. And once they find something that meets not only their criteria, but the investor's criteria as well, they get the green light from there. And then what happens here is the GP will send out an investment offering to the limited passive investor base. And what this is it's an offering of, summarizing the deal, of the strategies that the GP has set in place, different metrics, different return metrics. And this will give the LPs an opportunity to join in on the deal.
Yeah, that's perfect. And really, once that initial offering is made, it is sent out to a large investor base. So it is first come, first serve, first to commit the capital, because there is a certain amount that is normally wanting to be raised. And it's normally sold in shares. So it's based on specific shares that someone wants to buy or invest. And then moving from there, once all the capital is raised, it then moves to the next step of acquisition and financing. So once the capital commitment is secure, the sponsor then proceeds to acquire the property, negotiate financing terms, and close on the transaction. This involves coordinating with lenders, legal counsel, and other stakeholders to finalize the purchase and finalize the financing arrangements. From there, once the deal is secured, the next step, or the next big step, is really where the rubber meets the road. And that's the asset management and operation step, where the general partner then either has an asset management team and a property management team, who then are there to implement the strategy that the general partner has set in place. And really, this assumes the responsibility of managing the asset, overseeing day to day operations, and implementing the business plan to optimize the performance of the property. This may include renovations, repositioning, or, or optimizing operational efficiencies to ultimately increase the property's value and generate greater returns for the investor base.
Yeah, now that we're kind of, going down the roadmap here of the life cycle, I want to go back and just hit on a couple of those that you mentioned there in terms of the financing. Is it's important to know that with the financing, the 25 to 30% down payment is going to come directly from the equity that was raised. So that's going to go towards the down payment of the financing, and then you'll negotiate terms for the rest of the financing from there. And then moving on to, like you were talking about with the asset management, I feel like you covered it really well. And we've covered it in, I feel like, a couple different episodes now about how crucial the role is of the asset manager or the asset management team. And really what we're searching for as a GP, and I know this doesn't really apply to the LP in this circumstance, but when you're evaluating different asset managers from a GP's perspective, you're going to want to funnel or filter your search of who you want to be in control and asset managing the property, because I think it's important to note that you don't want to have somebody that is used to, let's say, managing bigger properties in their portfolio. They might be used to operating on a bigger scale of 2 to 3 plus 400 unit properties, where if we're looking for, let's say, something in the smaller range of 20 to 50, you're going to want to be able to find an asset management team that is familiar not only in that location, but also with the size and the scale that you're looking for. So I feel like that's an important note there in terms of the asset management role. And then from here, let's keep, coming down the roadmap here. Once you have the asset management team in place, they're operating the business plan that the GP has set out. From here and throughout the whole period of the deal is you're going to have communications directly from the GP. And what you're going to have these communications, it'll be in the form of whether that's an annual report, semi-annual report, or a quarter report 4 times a year. So you're going to be constantly getting, I wouldn't say constantly, but you're going to be getting regular communication with the GP about how the property performance is on that date or from that past quarter or from that past half year, whatever that looks like. You're going to be able to have a deep dive into understanding how the property is performing. So I feel like that's a really key part of being able to analyze and keep up to date of how your investment is doing.
Yeah, I think that's perfect. And I know as us as limited passive investors, always looking forward to those reports and really just getting a better understanding of how the property is performing, where the investment's at, what the strategy in place is still looking like. So I think that is a key point. And then, like you said, of being a roadmap, that last and final step is the asset disposition and distribution of capital at the end of the hold period, whether that be 3, 5, 7 years, whatever it may be. And really, what distribution comes down to, it depends on the GP and the deal. Either if there's been cash flow throughout the deal or if it's been planned as a lump sum at the end of the deal, because normally it's a preferred return of 8, 9%. Then past that preferred return, there are certain splits that go from 10, 15, 20%, whatever it may be, which is a huge note to make as well. And the general partner has this exit strategy planned ever before even acquiring the property. So it should be nothing new for the investors. They should know what's happening towards the end of the deal, how everything's going to be handled. And really, the main two ways that we've touched on prior is the disposition comes from either a refinance or a sale of the property. And then those proceeds are then distributed to the investors throughout the distribution waterfall that I mentioned, and that has been outlined in the operating agreement prior to the deal. So I know that's what everyone really looks forward to whenever they do get first started in a deal. And it is a process and it takes time. But I know as for us involved in deals, that's something that we're always looking forward to. And I know that's always what's in the back of the LP and passive investors' mind.
Yeah, Aaron, that's I feel like that's a good spot to kind of wrap things up for today's episode. And you kind of put a bow on the end there for us in terms of, going through the whole process of what does it look like for an LP to get into a syndication deal from start to finish. And, I know there's a lot of more in-depth things, but we're really just shooting to make these very quick listens for you guys so that you guys can, maybe turn it on in the car while you guys are driving, or, just something quick and easy for you guys to really absorb the information a lot easier. But outside that, a couple housekeeping items before we hop off here. I know you guys are really great about, showing love on our different social media platforms. So keep sharing, keep liking, keep promoting our stuff. We appreciate it more than you guys know. But outside that, I feel like, at the start of this podcast, Aaron, we mentioned that we're kind of looking at some deals to get the momentum going and get some things rolling. So right now, I feel like the best place for people to go, and if this is something where you guys are looking to get going too, definitely go over to our website at twinluxcapital.com. Drop in your information there. That way we can start to have those conversations with you.
Yep. You summarized it perfectly. Head over to our website and check that out. And we appreciate everyone for tuning in here to episode 6. Thank you.